Hi, it's Anthony here. I'm here to talk about a number that is becoming impossible to ignore, $1.3 trillion. The presentation today is titled The $1.3 trillion Time Bomb because we need to uncover the hidden risks growing inside the private credit bubble. It's a massive part of our financial system that few people truly understand. To understand the risk, we have to look at how the mindset has shifted. There was an old belief in the market that investment-grade debt was inherently safe and reliable, but that confidence is cracking. PIMCO's chief investment officer is now warning that this confidence is actually very, very dangerous. And they aren't alone. Moody's has stated that $300 billion in private credit could pose a systemic risk to the entire US banking sector. So how did we get here? A new financial world is emerging, split in two. On one side, you have the traditional regulated banks, which are retreating. On the other, you see the explosive rise of private credit. Three specific forces are driving this gap and making the ecosystem more fragile. First, the sheer explosion of private credit. Second, traditional banks have pulled back from risky lending ever since 2008. And third, the Fed is losing its ability to act as a backstop for the market. But let's pause for a second. What exactly is private credit? Think of it as the shadow lender. Unlike a traditional bank loan, these are loans made directly by funds, not by heavily regulated banks. The appeal for companies is obvious. It is bigger, faster, and more flexible. They can borrow huge sums in days rather than waiting months. But here is the catch. It operates with far fewer transparency and reporting standards than the traditional system. And when I say this market is big, I mean it is massive. If you look at the chart, US private credit alone has hit $1.3 trillion. Globally, some estimates put the wider market as high as $2.7 trillion. These assets have actually tripled in just a decade. To put that in perspective, private credit is now nearly half the size of the entire commercial loan market managed by US banks. Now, let's look at the risks, starting with danger number one. The system is built on borrowed money. Imagine a stack of layers. You have the borrower company at the bottom, the private credit fund in the middle, and the fund's investors at the top. Every single layer is leveraged. It is debt on top of debt. And the scary part, US banks have an estimated $925 billion exposure to these funds through loans and commitments. This leads us to danger number two, what lies beneath the surface. In public markets, we have transparent data and public reporting, but in private credit, it's the opposite. We have invisible financials and hidden performance. Because private lenders aren't required to meet the same transparency standards as banks, the true health of these borrowers is effectively invisible to the broader market. Distress remains hidden until it is too late. Danger number three is perhaps the most psychological risk, the illusion of safety. We are seeing investors increasingly outsourcing their judgment to rating agencies rather than doing deep credit analysis themselves. In some cases, a borrower might shop around until they find the single smaller agency willing to give them an investment-grade rating. To veteran investors, this complacency looks eerily familiar to the days right before the 2008 financial crisis. You might think banks are safe because they retreated from lending, but look at this cycle. It's a dangerous loop. First, banks retreated from risky corporate lending. Private credit funds stepped in to fill that gap. But then the banks turned around and lent billions to the private credit funds. We have created a system of added leverage, less transparency, and more complexity. This is not a theoretical exercise. The first dominoes are already falling. Right now, 1 in 10 private credit borrowers are deferring interest payments. We've seen 45 firms taken over by their lenders this year. That is a 6-year high. Even major funds at giants like BlackRock and Blue Owl Capital are showing signs of distress. I have to ask, does this sound familiar? Go back to 2008, we had subprime mortgages, opaque CDOs, and complacent ratings. Today, we have leveraged loans, opaque private credit, and complacent ratings. The CIO of PIMCO has warned that if this unravels, the next crisis could make the 2008 financial crisis not look quite as bad. And if you're looking for the referees, the watchdogs are playing catch up. The system grew so fast that regulation simply hasn't kept pace. Supervision is limited and transparent reporting isn't enforced. Crucially, there is no clear plan for what happens when stress in private credit spills over into the main banking system. So this is the new face of risk. It is a five-headed monster centered around the private credit system. We have explosive growth to $1.3 trillion. We have hidden leverage. We have a severe lack of transparency. We have that dangerous feedback loop with banks. And finally, the undeniable echoes of 2008. Risk hasn't vanished. It just moved into a faster, darker corner of the market. I'll leave you with the $1.3 trillion question. We have built a system on speed, leverage, and opacity. The question is, what happens when the economy slows down? So that pretty much wraps it up for this video. I hope you enjoyed the content, and if you've gained anything from the video, help me support the channel with a thumbs up. Definitely comment and let me know your thoughts. Hit the bell if you'd like to be notified of more content like this. With that, I hope you have a fantastic day.